Most of us know on the most basic level what life insurance is. It's something you buy to protect those you love financially, if or when you pass away, to create an instant estate, to build generational wealth. But how much do you know about the companies that sell you life insurance? And does it really matter if you buy your life insurance from company A versus company B? For loyal subscribers and viewers, welcome back. We love you guys. And for those of you new to NestEgg, welcome to the #1 place to learn about money, insurance, and retirement. I'm Jennifer, first-generation American, and I've spent most of my life in finance. Started working at banks like JP Morgan and Goldman Sachs at the age of 17 and graduated top of my class from NYU and Harvard Business School on scholarship. And now I work with companies like Bloomberg, WeWork, and Walker Edison, teaching their employees all about personal finance. So, did you know that there are mutual life insurance companies and stock life insurance companies? And that buying from one means you get dividends, and buying from the other means you probably don't. And that's what we're going to talk about today. By the end of this video, you'll know what a mutual insurance company is, what a stock insurance company is, what the difference between the two are, and how buying life insurance from one versus the other might impact your policy. Let's start with mutual insurance companies first. Mutual insurance companies, like stock insurance companies, can sell life insurance, disability insurance, long-term care insurance, home insurance, auto insurance, and all other types of insurance. Unlike a stock insurance company though, a mutual insurance company is owned by its policyholders, people like you and me who buy our life insurance policies from them. Mutual insurance companies issue participating life insurance policies, meaning that you and I are entitled to dividends. If you're a bit new to life insurance, be sure to check out this whole life versus term life video here to learn more about life insurance basics and terminology, the different types of life insurance policies that are out there, and which might be best suited for you. So dividends. The dividends that we as policyholders receive from our mutual insurance company are calculated by adding the premiums that we pay to the mutual insurance company together with the company's earnings and subtracting from that the actual cost of running the company and providing coverage. The simplest way to think about this is that the mutual insurance company is giving us, as their owners, back a part of its profits, like any other company would do for their shareholders. The big advantage here is that unlike actual dividends paid on any shares you own in a stock insurance company, these dividends that we receive from our mutual insurance company are not taxable. The two life insurance companies that we work with closest, Guardian and Mass Mutual, are both mutual insurance companies, and they're both considered top-notch in their industry. As always, we only work with the best of the best. Now, the top 3 reasons that our young clients buy life insurance, or any of our clients for that matter, is to 1, protect those they care for financially in case they pass away unexpectedly, 2, to create an instant estate for their loved ones, and 3, to build generational wealth for the future. The last thing you want to do is hook up with a life insurance company that won't be around anymore down the line when your beneficiaries need that death benefit the most. Take a look at these videos here to learn about how others like you are using life insurance to create a nest egg and build generational wealth for those they care about. So, Guardian was founded in 1860 and Mass Mutual in 1851, before telephones were invented. And both have paid out dividends to their policyholders consistently over the years. In 2021, Guardian's dividend rate to policyholders was 5.65%, and Mass Mutual's was 6%. Having said that, not all mutual life insurance companies receive the high ratings for financial strength that Guardian and Mass Mutual do. So just keep this in mind when you're thinking about which life insurance company to buy your life insurance policy from. And remember, dividends are not guaranteed. The mutual insurance companies can only pay them out if they earn a profit. Besides which company to go with, there are lots of other things to consider when choosing a life insurance policy, whether it's for you or someone you love. Things can get complicated fast, but it doesn't have to be. So if this is something you're seriously considering, shoot us an email at jennifer@diamondnestegg.com to see if we can customize a life insurance policy for you or your loved one. Let's move on now to stock insurance companies. A stock insurance company, unlike a mutual insurance company, is not owned by policyholders like you and me who buy our life insurance policies from them. A stock insurance company is owned by its stockholders or shareholders. I'll use the term stockholders and shareholders interchangeably in the rest of this video. Think of a stock insurance company like you would think of Apple, Microsoft, or Amazon. But instead of selling iPhones, iPads, software, and toilet paper, the stock insurance company sells life insurance, disability insurance, and so on. And just like Apple, Microsoft, and Amazon, the objective of a stock insurance company is to be profitable and distribute these profits to its shareholders, not to the policyholders. If the stock insurance company makes money, the shareholders share in the gains. And if the stock insurance company loses money, the shareholders also share in that loss by seeing the value of their shares drop. Policyholders like you and me don't share in any of the stock insurance company's gains, nor its losses. And if the stock insurance company pays a dividend, we also don't get any of that either, unless we own actual shares in the stock insurance company, that is. Because the policyholders don't participate in receiving the dividends, the life insurance policies issued by a stock insurance company are known as non-participating policies. Also, the dividends paid out to shareholders by a stock insurance company are taxable, unlike the dividends paid out by a mutual insurance company. Some stock insurance companies you may have heard of include Prudential, MetLife, and Allstate. So, is it better to buy your life insurance policy from a mutual insurance company or a stock insurance company? Many folks feel mutual insurance companies have an edge over stock insurance companies because there is an alignment of goals. The mutual insurance company is there to serve the policyholders who own the company in the short term and in the long term. It's probably for the same reason then that customer service at mutual insurance companies can sometimes seem to be a bigger priority. The policy owners are also the owners of the company. Compare this to a stock insurance company where the short-term interests of the investors, say cost control, may not be aligned with the long-term financial demands of the policyholders, like better customer service and more frequent communication. The way we see it, all things being equal, when it comes to long-term coverage, like with life insurance, disability insurance, and long-term care, you may want to opt for a more customer-friendly, service-oriented mutual insurance company. Because you'll be dealing with this company for a very long time, hopefully. And when it comes to short-term coverage, such as insurance for your car or home, basically insurance that you renew every year, and where it's relatively easy to switch companies, you may want to shop around with the stock insurance companies, which may be more price-oriented and cost-sensitive in some of these products. So we don't do car or home insurance, but if you're in the market for life, disability, or long-term care insurance, shoot us an email at jennifer@diamondnestegg.com to see if we can help design a policy that best suits you and your life, family, career, and financial circumstances. Guys, we hope you enjoyed this video and learned something new. If you did, please don't forget to give that thumbs up and the subscribe button a gentle tap. We'll be back next week with another money-saving, wealth-building video just for you.